Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, August 13th, 2024. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, is the U.S. economy in or near a recession? What does the housing market signal about the U.S. economy? Is it appropriate for the Fed to still be so concerned about price stability? And will Beijing finally step up policy support for the Chinese economy? Our answers are the July NFIB Small Business Optimism Survey pushed back on the increasingly loud bear porn suggesting the U.S. economy was already in or close to recession. That said, the latest guidance from Home Depot is confirming of our call for growth to slow over the medium term. That is one data point that suggests growth might be slowing faster than we expect. It is important for investors to rely on independent signals from a variety of sources when making determinations about something as critical to asset markets as the U.S. growth cycle, and the preponderance of evidence continues to point to a moderating economy with a softening labor market that is unlikely to enter recession over a medium-term time horizon. To preserve the economic expansion, the Fed should stop inappropriately anchoring on both sides of its dual mandate. The July PPI data were the latest to support our call for inflation to continue surprising to the downside over the medium term. China's July credit data were so bad that they actually support our China front-loading stimulus theme. We expect Beijing to respond forcefully from here with incremental policy support. Transitioning to our 42 macro dashboard here. As always, we'll wrap up with a question from our client community here. This one's regarding leveraged ETFs. It says, good afternoon all. I was wondering what people's opinions are on using leveraged ETFs, such as TQQQ, as the equity exposure for KISS. Thank you. So obviously this question was posed to all of our client base here. So I just want to chime in with my thoughts on leverage ETFs. Generally, I'm not a fan. 99% of the time, I'm not going to be a fan of leverage ETFs, but there is that 1% of the time where I do think it can add value, and that's in the return stacking context. I want to say, I think it's Corey Hofstein over at Newfound Research has done a lot of really thoughtful work on this concept of return stacking, which essentially is using levered exposures for your beta to capture beta in the equity and fixed income markets, and then the resulting sort of residual of the position that you otherwise would have had in Delta One terms. You take the half or the third of that position, and then you use it to allocate to sort of high yielding cash like instruments. So, for example, let's say you had a 60%. You were supposed to have a 60% exposure to equities in a 60-40 portfolio. You can use a levered ETF, a 2x levered ETF, to only have a 30% position, and then you take the other 30% position that you kind of have now freed up, and you can use it to invest in something like T-bills or some other high-yielding cash-like instrument. So that, in my opinion, is a relatively safe way to implement return stacking into a sort of relatively safe way to implement leverage ETFs into a portfolio. I can't think of a better another instance where it's actually a good idea to add that kind of volatility to your portfolio. And oh, by the way, the thing that's very concerning about levered ETFs is that they often have significant tracking error, both to the upside and downside, when you're in these big market moving type events like what we saw with the unwind of the yen carry trade, and obviously in any sort of big drawdown in asset markets or significant recovery in asset markets, they tend to have a little bit of tracking error because it's just hard to manage those products from the perspective of the institutions that are supplying you with that leverage. So that's about as much as I'll say on leverage ETFs. Actually, no, the final thing I'll say on leverage ETFs is they do come with a higher cost. So like if you think about Qs versus TQQQ, for example, I want to say the Qs have an expense ratio somewhere around 15-20 basis points, where something like TQQ will have an expense ratio of 1% or higher. And so you are going to pay to return stack or to willy-nilly use leverage ETFs in your investment process. So I just want to make sure investors are well aware of that. But generally speaking, leverage is a no-no from my perspective. If you can, investing's hard enough. Most of us are not smart enough to be applying leverage to our portfolios unless we're doing it again in return stacking context, which should reduce a little bit of the volatility that you would otherwise experience using leverage products. So we'll wrap it up there. Hopefully that was a good enough explanation. We'll catch you guys back here tomorrow at the same time. Everyone have a wonderful day. Best of luck out there. Cheers.